Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So, when I was in elementary school, one of my favorite things was a field trip. Most of you can probably relate to that, right? Even if you weren't interested in going wherever the field trip was taking you, you got to get out of class for a day. So that was a bonus in and of itself. But I remember going on some pretty cool field trips. My favorite was the fire station because I was convinced I was going to be a firefighter. But, who doesn't like to get away and see something new and get out of the routine? Well, I got to do that last week. I took a field trip of sorts all the way out to Boise, Idaho, Eagle, Idaho, to be precise, which is the home office of Money Metals. And I got to meet a lot of my coworkers that I'd never met before and got to get a firsthand look at the operation. And it was very impressive. And I want to talk a little bit about some of the things that I saw. But before I get to that, I want to touch on the Federal Reserve meeting last week because that was pretty significant. And before I do that, I want to thank you for listening to the show. It means a lot to me. I know there's all kinds of things out there for you to listen to, and you choose to spend a little bit of time listening to this show, and it is very much appreciated. Now, if you want to help the show a little bit, you can do one very simple thing. Go to wherever you're listening and leave us a review. Hopefully a good review, but an honest review. Give us those 5 stars. Give us those thumbs up. Share the episodes on your social media feeds, and that'll help grow the reach of the show and, ultimately just makes the family bigger. So if you would do that, I would say thank you. And I also want to call your attention to a product that we are offering here at Money Metals Exchange. Beautiful 1-ounce silver rounds in honor of Charlie Kirk. On the head side, there is a beautiful colorized portrait of Charlie. And then on the tail side, you'll see the Turning Point USA logo and a quote by Charlie. It says, "Courage is committing yourself to the correct course of action, regardless of the cost." And again, beautiful piece of memorabilia in honor of Charlie Kirk. And all of the proceeds are going to go to Turning Point USA. So this isn't something that Money Metals is making money on. We just want to offer it to folks who are interested, who thought highly of Charlie and help out Turning Point USA. So check that out. I'll link to it on the show notes page, and you will also find it right. Just go to moneymetals.com, and you can see it right on the front page. So do check that out because they're absolutely gorgeous. So about the Federal Reserve. Economist Thomas Sowell wrote, "There are no solutions. There are only trade-offs." And that's exactly what the Fed is dealing with. That is the perfect quote to describe where the Federal Reserve is right now. The Fed is stuck between a rock and a hard place. And I've been talking about this for months and months. If you're a regular listener to the show, you know exactly what I'm talking about. They had to make a choice, right? They could either hold rates steady and hope to drive down this persistently sticky price inflation situation, or they could choose to give the sagging economy a boost, and it's definitely sagging, right? They covered it up for a long time by basically faking jobs numbers and then all of a sudden erasing nearly 1 million jobs with revisions. But we know the economy is slowing down. It's dragging. And so they had to cut rates, hoping that that would boost the economy and avoid a recession. They recognize, and they're not going to say this out loud, but they recognize that the economy is addicted to easy money. It needs that easy money fix. We went nearly 2 decades with way lower than normal interest rates, 0%, right? That's not the norm. The norm is where we are now, actually. But we had this abnormal, loose monetary policy. It created all kinds of malinvestments. It incentivized all kinds of debt, and the economy simply can't function in a higher interest rate environment. So they had to choose, right? No solutions, only trade-offs. So they chose the latter, meaning they picked inflation. Despite acknowledging in the official FOMC statement, inflation has moved up and remains somewhat elevated. When you see that sentence in a Federal Reserve statement, you would not expect that to go along with a rate cut, but that's exactly what they did. The FOMC voted 11-1 to cut the federal funds rate by a quarter point last week. So that sets the Fed's interest rate between 4 and 4.25%. And the committee projected 2 more cuts before the end of the year. So we are in cutting mode. In the official FOMC statement, the committee expressed concern about the softening economy, noting that, quote, economic activity moderated in the first half of the year and that job gains have slowed. Yeah, they have. Again, the BLS erased nearly 1 million jobs from the official numbers just with the few clicks of a computer mouse, I guess. However, Federal Reserve Chairman Jerome Powell characterized the rate cut as a move to mitigate risk, not to rescue the economy. So this is where the messaging comes in, right? The Federal Reserve is all about open mouth operations. The things that they say are designed to move and direct the markets. That's why they say them. Their blah, blah, blah is as much a part of monetary policy as the actual policies that they set. So they say things. And so when Powell called it a risk mitigation move, he was signaling something. He was signaling that this is not a desperate attempt to rescue the economy. He said, you can think of this in a way as a risk management cut. That's exactly how he put it during his post-meeting conference. Now, many market observers took this as a more hawkish sign, assuming that this cutting program is going to be limited, okay? And I think it's interesting because although Powell never used the word, and I'm not sure you're going to hear this word come out of the Fed ever, but he basically described a stagflationary setup. And we've heard this actually start to be bandied about quite a bit in the mainstream, this word stagflation, the idea that we have low or slowing economic growth along with persistently high inflation. So this is what Powell said. He said, while the unemployment rate remains low, it has edged up, job gains have slowed, and downside risk to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. So that's the two sides of the stagflationary coin. We have a slowing economy as indicated by a slowdown in employment growth, and then we also have this persistently elevated price inflation, stagflation. So, welcome to 1975, right? Now, there was one no vote, and that was recent Trump appointee Governor Stephen Miron, and he actually advocated for a half-point cut. So there really was nobody, at least as far as we can tell, and we'll get the minutes down the road, but it doesn't seem like that there was a whole lot of resistance to cutting rates. Now, the other thing that happened during this Fed meeting was the FOMC released its dot plot, and that kind of tells you what they're projecting out over the next couple of years. And the dot plots indicate 2 more rate cuts this year, as I've already mentioned. However, the committee now only anticipates 1 rate cut in 2026. And if we go back to just the June meeting this past year, they were projecting 3 rate cuts in 2026. So they really ramped down the anticipation for rate cuts next year. And again, this is why a lot of people kind of perceived this as some hawkish messaging coming out of the Fed. But when you look at the dot plots, it's important to note that there was a lot of divergence in the forecast, right? There were 2 members who projected as many as 4 rate cuts in 2026. So while they seem to be in lockstep when it comes to this current rate cut and maybe 1 more moving forward this year, there's a lot of divergence once you start trying to look out into the future. And I'll say this too, this is important. Analysts tend to get all excited about these dot plot forecasts, and markets move because this is the forecast, this is the anticipation, this is the expectation that's being set, right? These dot plots are virtually meaningless, right? Fed members are notoriously bad at projecting the trajectory of interest rates, even though they're the ones who literally set the interest rates, right? How bad is their track record? There was a fund manager, his name's David Hay, and he actually analyzed the past dot plots, and he found that the FOMC only got interest rate projections right, get this, 37% of the time. And as he pointed out, they control the interest rates, and yet they could only be 37% accurate in what they're forecasting. So, yeah, the FOMC would probably get better results by flipping coins or throwing darts at the wall. But they're not going to do that. They're telling you that this is all very scientific and data-driven. I think that they're throwing crap at a wall and seeing what sticks, but that's just me. So anyway, it's important to understand that what we're seeing here is by definition inflation, this loosening of monetary policy. And I keep saying that over and over again. And I've gotten some pushback on that. They're saying that interest rate cuts aren't inflationary, but they absolutely are. When you have a fractional reserve banking system, whenever banks make loans, they don't have to have all of the money available to back up the loan, right? They only have to have like 10% of their outstanding loan portfolio backed by actual reserves. So they can literally create money out of thin air. So when there is a lot of borrowing and a lot of lending going on in the economy, it is by definition increasing the money supply, which is inflationary. Now, somebody pointed out in a comment on an article I wrote, and this is a good point, that when the lending, when borrowing is associated with the production of real goods and services, then it actually grows the economy, and that inflationary effect is not going to manifest in price inflation. And that's a fair point, but it's still by definition inflation. When we define inflation correctly as an expansion in the supply of money and credit, right? That's the definition, an expansion of the supply of money and credit. And credit is right there, right? We're expanding credit. That's exactly what the Fed's doing. It is inflationary. It's not as inflationary as quantitative easing. And certainly there are other factors in the economy that will dictate how that inflation will manifest, right? Monetary inflation manifests in different ways. It can manifest in consumer price inflation, which we saw after the pandemic, but it can also manifest in asset inflation, where we see the stock market rallying. In fact, I've seen some pretty interesting projections that the stock market's going to continue to rally because it's getting this boost by this inflationary monetary policy. But the fact of the matter is, we've been in an inflationary environment in the true sense of the word since last year. As of the end of July, the money supply had expanded by more than $600 billion since its low point in mid-2023. As of July, the M2 money supply was at $22.12 trillion. That is above the peak reached during the pandemic. So what we saw is when the Fed started really raising rates and really aggressively trying to tighten monetary policy, when we had that, 8-9% CPI, we did see a contraction of the money supply, which is literally disinflation, right? That's what you need to drive those prices down. But it didn't last very long. We immediately, well, not immediately, but as soon as the Fed started cutting, we started to see the money supply expanding again. So we are in an inflationary cycle already. And I mentioned this a lot. I think it amuses me a little bit because it's the Fed's own metric, but it does indicate that monetary policy is still historically loose. If you go look at the National Financial Conditions Index, it has been negative the entire time. It never went positive. We never had historically tight monetary policy, at least according to this metric, throughout the entirety of the tightening cycle. So what I'm driving at here is that inflation is not dead. Don't think it is. This is inflationary. The Federal Reserve has chosen inflation, and they always do. This isn't surprising. And if we see a big crash in the economy, if we do see a recession, you can expect deeper cuts. I would expect them to go to zero because, that's the only way they're going to get any effect. And then they'll have to go back to quantitative easing, which is literally money creation by the central bank. So why cut rates, right? Why do that if we're still seeing this inflationary pressure, especially given the CPI data, which indicates inflation is alive and well. And, the truth of the matter is the CPI data actually understates inflation. But the reality is that the economy is showing cracks, and Powell acknowledged that. He didn't want to see any further deterioration in the job market. And so this all just underscores this catch-22 that the Fed has been in now for really a year. They've been battling this, kind of trying to walk this tightrope. Can we keep this bubble economy inflated and keep inflation low enough that people don't freak out? That's what they're trying to do. So, here we are. They can't simultaneously raise and lower rates, and you can make a good argument for both. In fact, I've thought about, doing a show where I actually make the argument for rate cuts and then make the argument for a rate increase, and you'll see that both of the arguments are legitimate. I mean, I could make a good debate or make a good case for either side. But here we are. They've chosen inflation, and that is key. They've chosen to try to keep the air in the bubbles at the risk of unleashing more inflation. And of course, that's bullish for gold. Not only because gold is an inflation hedge and you want to have some in an inflationary environment, but also because it's going to tend to drive real interest rates lower. And gold and silver are non-yielding assets. That means they don't generally generate income from interest or dividends or rental payments. Gold and silver's value is derived from price appreciation alone. So when interest rates are higher, there's an opportunity cost to holding gold and silver. You could own bonds that generate interest income or stocks that pay dividends. However, when real interest rates fall or turn negative, those income-producing alternatives lose their competitive advantage. And in such an environment, the relative cost of holding precious metals like gold and silver diminishes. It makes the metals more attractive as a safe haven and wealth preservation asset. So what do I mean when I'm talking about real interest rates? Well, the real interest rate is simply the stated rate you see on the news adjusted for price inflation. So to calculate the real interest rate, you take the quoted nominal rate and you subtract the CPI. So let's use a 10-year Treasury bond as an example. Let's say that bond is yielding 4%. Seems like a pretty good return, right? But if the CPI is running at 3.5%, the real interest rate on that bond is only 0.5%. Right? You take your 4% stated yield, you subtract the 3.5% CPI, and you end up with a 0.5%. Note that in a really low interest rate environment, or if price inflation gets particularly high, real interest rates can go negative, which in fact they were earlier in the inflation cycle. So if that same 10-year Treasury is only yielding 3%, and let's say the CPI is 5%, your real interest rate is negative 2%. That means you're losing money in real terms if you buy and hold that bond. And of course, when I use calculations like that, we're assuming that everything else is remaining static. So if you take the CPI at face value, the current real interest rate is between 1.6 and 1.25%. So that's the Fed funds rate minus the current CPI of 2.9%. That's not a great yield, and it explains why we're seeing this appreciation in gold. And it just keeps going up, right? We're in this environment where it's very bullish and favorable for gold. We saw gold very nearly touch $3,800 an ounce last night or yesterday. Silver was near $45 an ounce. So both of these metals continue to rally, and this loose monetary policy is going to continue to support gold moving forward. And of course, as I already mentioned, you got to keep in mind that the true price inflation rate is higher than the CPI indicates. They revised that formula back in the 90s, so it understates the actual rise in prices. If you take the 1970s CPI formula and run all of today's numbers through there, we're looking at closer to 6 or 7% price inflation. So what I'm saying is there's really no opportunity costs in holding gold or silver right now. And this is extremely bullish for precious metals and explains why prices have rallied every time the Fed has hinted at cutting rates. And it's one of the reasons many analysts believe that the gold and silver rally still has plenty of legs left. And, here's the truth. Although they're never going to say it out loud, the central bankers over at the Fed prefer negative real rates because it softens the government's massive debt burden. And that's another part of this equation. We're hearing all this stuff about, Fed independence. The Fed's not independent. The Fed is part of the government. It is literally designed to support government borrowing and spending. It's part of what it does. So the powers that be, they want inflation because it erodes away some of their debt. And so, sorry that it's a burden on you, but, Uncle Sam's got some things that he's got to take care of. So you're just going to have to suck it up, Buttercup. But anyway, what I'm driving at here is, as an investor, it's crucial that you pay attention to real rates, right? If you fail to grasp the concept of real interest rates, you can easily be fooled by media headlines as they tout higher interest rates and, even when real rates are negative. So let me tell you a little bit about my field trip to Eagle, Idaho, and the offices and bullion depository of money metals. Really, really an impressive operation. And, this is the first time I've been working with the company for over a year and a half now, but this is the first time I've actually been able to go out and see the facility, see how the operation actually works. And I was more impressed than I expected to be with what I saw. And, I'm saying this obviously as an employer, and you can take it with a grain of salt, of course. But the reality is after seeing the operation, I have 100% trust in doing business with money metals, whether that be buying or selling gold or silver to or from money metals, or storing metals in their vaulting facility. It's an impressive operation. And the first thing that I have to say, it's kind of cool because we live in this weird world where we can work remotely. And this is the first time that I've ever met anybody that I work with face to face. Like, we've been working via, remote online stuff this entire time. So it was really cool to actually, get to hang out with the people that I work with. But the first thing that really impressed me was that Money Metals has a really high quality employee. Like, it is a great bunch of people. It's a great team. I didn't see anybody in the facility that was like, I don't want to be at work. Everybody was enthusiastic. Everybody seemed engaged in their work. It was just a very positive environment. And believe me, I've been in some bad work environments, and it's easy to tell when people are not happy with their job. These folks are happy with their work. And, at the end of the show, I'll often say, talk to a money metals, precious metals specialist. Give them a call. Ask them questions. They're fantastic, and they can help you kind of navigate precious metals investing, especially if you're new to it. And my confidence in saying that is even higher, having spent a little bit of time interacting with some of our precious metals specialists. They do, in fact, know what they're talking about. They're very knowledgeable, and they can answer your questions and kind of guide you. So if you have questions about gold, silver, precious metals, don't hesitate to call 800-800-1865 and talk to one of those folks, because they're just good people, and they're genuinely interested in helping you understand how to preserve your wealth in this crazy inflationary time. But I think the thing that was the most impressive to me, and kind of stepping back and kind of looking at it objectively, is the facility and the processes, right? And I'm especially talking about the way that metal moves through the process, right? If you place an order for gold and silver, or if you send gold or silver that you've sold to Money Metals, the process that it goes through is phenomenal. And it's very proprietary. Like, I wouldn't try to explain some of these processes to you, but they involve things like redundancy. They involve making sure that different people are handling different aspects of the transaction to ensure security. The steps that are taken to make sure that things are done right and securely and above board are amazing. And it starts with the facility itself. The security is pretty mind-blowing. I got to see some of the technology that is being used to secure the bullion depository. Just let me put it this way. You don't want to try to rob this place. It is not going to go well. And not just because of the technology that's in place, but because of the security team, a really great bunch of guys. And it's interesting because being in Idaho, it's kind of a Second Amendment friendly state to begin with. And so employees at Money Metals are allowed to carry firearms if they choose to do so. And the company will actually even help with like training and permits and things like that. Virtually everybody in the facility is packing. So, it's not a place you want to go and make trouble. But again, I think it's the processes that are really the most important. And that goes from, processing orders to ensuring that all of the gold is where it's supposed to be in the depository. The depository actually has several separate vaults. It's really cool because if you are storing gold and silver at Money Metals and you're worried about, well, maybe it's getting mixed up with somebody else's gold or something, you don't have to worry about that. The processes are in place and you can call up and tell them your name. And, so let's say you have, 50 ounces of silver that you're storing in our depository. They can go and find exactly where your coins are and put their hands on those coins. Your coins are not mixed up with anybody else's metal. They're in their own box, and it's all automated and digitized. It's just super cool. I know I sound kind of nerdy and maybe over enthusiastic, but it's just neat. And I mean, I'll be honest, it does kind of feed the nerd bug. When I was in the vault, I actually got to stand next to a pallet of 70-pound silver bars. And I was told that pallet, one pallet of those silver bars is worth over $1 million. It's pretty wild to sit there and put your hand on that and think about, oh, this is $1 million, right? But again, the auditing, the double layers of security, all of these things are in place. And here's the thing, when it comes to storage of metals, I've talked about this on the show before. There's kind of two paths that you can take. You can store your metal on your own. You can have your own vault in your home, and in a sense, that's the most secure for you because you have your metal in your hands. You can go pull it out of your vault. You can touch it. You can take your gold coin up the street and sell it. So you have physical custody and possession of your metals. There is no counterparty risk when you are storing your own metal. You are your own party. There is no counterparty. And that's the beauty of gold and silver, right? There is no counterparty risk. A counterparty is somebody on the other side of the transaction. So like if you have money in the bank is the counterparty. That bank could fail or go under, or somebody could embezzle your money. You could lose your cash because of something that this counterparty does. That's your counterparty risk. And virtually every transaction has some counterparty risk. Your dollar has counterparty risk because it is backed, quote unquote, by the government, right? So the Uncle Sam in that case is your counterparty risk. And if you ask me, that's a pretty high level of risk there. But gold and silver have no counterparty risk. They stand on their own. Their value is intrinsic, right? You don't have to worry about somebody on the other side of gold and silver failing. Gold and silver will always be gold and silver. But if you choose to store your metal in an outside bullion depository like Money Metals, you are introducing some level of counterparty risk. And, it's just going back to that quote by Thomas Sowell. There are no solutions, only trade-offs. And sure, when you store your metal in your house, you have physical possession of it, and there's no counterparty involved. But the fact of the matter is, there is the risk that somebody could break into your house and steal your gold and silver. And I guarantee you that your house is not nearly as secure as the Money Metals vault. Now, if you store your gold and silver in Money Metals vault, there is some storage fees involved there. So there's that. But you have a higher level of security. You don't have to worry about somebody breaking into your house and stealing your gold and silver. And as I said, given the systems and the processes and the audits that are in place, your metal is as secure, nearly as secure in that depository. It's actually probably more secure in the depository than it is in your house. But you do have, that counterparty risk involved. So you have to decide what the trade-off is. I think a lot of people hold a little bit of their precious metals in their home, so they have access to it, and then they'll store additional in a depository, so they don't have millions of dollars in precious metals in their house. But again, you have to figure out what those trade-offs are. But what I'm really driving at here is that if you are thinking about storing metals at our bullion depository, you can rest assured that the processes and the security is in place. We know that every bar of gold is in the depository, and we know when a bar of gold leaves the depository, and it's just very secure. It's an impressive operation. And I'll be honest with you, I came home being very proud to be associated with Money Metals. And, let's be honest, there are a lot of shady characters in the precious metals world. There's a lot of unscrupulous dealers out there. You have to beware. Do your homework. I'm not telling you to take my word for it. Do the research that you need to do. But it is an impressive operation, and that bullion depository is so freaking cool. I mean, I wouldn't hesitate for 1 second to store my precious metals in that facility. And, the same thing goes for buying and selling precious metals through Money Metals Exchange. The processes are in place to make sure that your transaction is smooth and that you get the metal that you expect to get. So, yeah. All of that to say, give us a call, 800-800-1865. Talk to one of those precious metals specialists. Avail yourself of their knowledge. Ask them questions. They will be happy to answer them. And, they can sell you some of those beautiful Charlie Kirk rounds if that's something you're interested in. Or if not, there are plenty of precious metals products for you at Money Metals Exchange. Now's the time. Gold keeps climbing higher, but there is still plenty of room for it to move up. And we've talked about the bullish setup that we have. So, I think especially silver, there's still plenty of upside. So give us a call today, 800-800-1865. If you don't want to talk on the phone, you can chat with a precious metals specialist online at moneymetals.com. Or if you know what you want, you can just go to the website and you can buy straight from there, and it'll be packaged up and shipped out to you. So do it today. So that's going to be a wrap for this episode of the Money Metals Midweek Memo. You can get more information on everything that I've talked about today over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up. Get on our email list. We have over 1 million people on our email list, so join them. And of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. When you do, you can also tune into our Market Wrap podcast every single Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold and silver, economics, and investing. This week, I'm going to be talking to Nomi Prinz, a very interesting person. We're going to be talking a lot about the Fed and the trajectory of monetary policy, so you'll want to check that out. Thank you again for listening to the show. I hope you have a fantastic rest of your week. Again, please share the episodes, give us those good reviews, and have a fantastic rest of your week.